not going to talk about politics. We are going to talk about the effects going forward of this last election. I think it's a pretty reasonable topic. It's something we all need to deal with. The markets have already made some astonishing judgments on what's going to happen. Excuse me. I'll just tell you in passing. Let me just check the sound here. Where did we go? All right, we lost our picture here. Let me just check on the sound. Lost our picture here. Yeah, it's coming back. Sorry about that. Let me just check on the sound. Yeah, it's coming back. Sorry about that. Okay, let's go, folks. This, of course, is the topic du jour, du week, and probably du year, and probably du half decade at the point we're dealing with right here. It was an astonishing election, not so much in the result, although, of course, we can all have our own opinions about that, and that is not my topic. But what is most astonishing is the absolute misperception that this election generated everywhere. And I don't just mean here in the United States, but around the world. Is the absolute misperception that this election generated everywhere. And I don't just mean here in the United States, but around the world. Okay, folks, I think we have a bad sound connection here. I'm going to have to go out and come in again. We have an echo. So I'm going to shut this down. I'll be back in about 2 seconds. I'll be right back. Go out and come in again. We have an echo. I'm going to shut this down. I'll be back in about 2 seconds. I'll be right back. Hello, everyone. We're back. Just trying to get rid of the echo on my line here. I think I have. Okay. Hello, everyone. Echo on my line. Okay, let's try this once more. Sorry, folks. I had to get rid of an echo on the line. Okay. Give me 1 second here to pull up one more screen. I think the echo is gone. As I've said many times, good technology, great technology, but not totally perfected. Okay, I think we're set. Again, sorry for the delay, folks. As usual, if you have any questions, comments, considerations, or my oft-requested jokes, does no one know any jokes? I have to depend on my my 8-year-old, who's one of my 8-year-olds, who's reading jokes from her joke book. Trouble is, they all tend to be knock-knock jokes. I suppose I could write a knock-knock joke or ask her to write a knock-knock joke for the election here, but too many people are not taking it very seriously, are taking it far too seriously. The reason I have this up here is because this gives you an approximation of what we're talking about. The main story so far in this election in the United States, aside from the politics, I'm talking about markets, has been the enormous misperception about what was happening. This is the best predictor before the election, real clear politics, no toss-up state map of what would happen in the election. As you can see, this particular map had Hillary Clinton winning 272 to 266. You need 270 to win. It's a long, elaborate story, but I won't go into it now as what you need. The actual result for last Tuesday's election will most likely be 306 to 242 in favor of Donald Trump. No one, except for very few commentators, mostly of a political stripe, expected this. I myself wrote, the best I wrote, was that you can't gainsay the polls. Hillary Clinton is the favorite. I wrote this about a week before the election. Hillary Clinton is the favorite. However, markets and commentators in general should not be surprised if Donald Trump does much better, and his chances of winning are far greater than most people anticipate. That was my take on the election before. So I don't get any credit for being right in predicting this. Now, let's look at, again, what we're going to be talking about here is the market reaction, not our reaction. This is not about what we think about, or at least not what I think, about Donald Trump's election. And he has been elected. We can say that this is not our election. There are many things that are going on like this now in the States. The one thing we must all really like about markets, and I certainly do, is they are agnostic to politics. Now, what do I mean? Are they agnostic? No, look at this chart. They're obviously not agnostic. But they are agnostic as far as the political values go. This chart is not a judgment on what's going to happen to Obamacare. It's not a judgment on what's going to happen to the Supreme Court. It's not a judgment on the myriad political questions that are settled to some degree by an election. That's why we have elections, of course. We have one of these every 4 years. What is affected, of course, is the market's view of where the economy is going, of the things that concern it, where the market's going, where the economy is going, where interest rates are going. And as we look through these charts, the election is not yet a week away, rather astonishing week. As one of my favorite columnists, Peggy Noonan, who used to be a speechwriter for Ronald Reagan in the generation ago, said democracy is alive and well if it can still produce results that no one anticipated. And what she meant by that, much as in the British election in June, was that if a people are strong enough to make up their own minds, regardless of what they are told in the media or in academia or anywhere else, if they are still strong enough to make up their own minds, then they are still a free people. And unexpected events in elections qualify for that. Again, this is not meant to be a commentary on the election or the politics of Donald Trump versus Hillary Clinton. I have my opinions, but they do not belong here. But it is a comment on the market perception of what happened. Okay, this is the DXY, our base, where we're going to start with the DXY, then we're going to go to the equities, then we'll look at some of the credit markets, and we'll move on. You know, it's funny, I'll just tell you something in comment. I've been amazed, and I've been around markets and politics for a good many years. I've been amazed at the passions that this particular election has excited. I have, you know, I write weekly and periodically, and I send it out to a long mailing list of journalists and acquaintances and also others. I never put anyone on the mailing list unless they request it, or I ask them if they want it at least. And I have never, and I mean never ever, in about 8 years of doing this kind of commentary, maybe 6 years of doing this kind of commentary, had anyone ever asked me to take them off their mailing list until today. I wrote a column last week on Friday and sent it out. I'll tell you how I started it. It's partially based on the write-up for this webinar. I started it. A week helps put things in perspective. I labeled it, I changed that in the column to a week after the U.S. election puts things in perspective. The initial equity panic at the election of Donald Trump turned into joy as the Dow set an all-time record on Thursday. That's a simple statement of fact. That's what happened. And I had a number of people come in this morning and ask me to take them off their mailing list. Perhaps it was the use of joy, which is a word with the positive connotations. Excuse me. This is a chart of the DXY. This is October 28th. Okay, that is the day when the FBI director, James Comey, reopened, supposedly, the investigation into Hillary Clinton's use of a private email server when she was Secretary of State. They found some other emails on somebody else's computers. Long story there, not worth going into. Taken, as you will see, across all markets as a negative for the market's interests, in this case, the DXY. This point right here at the bottom is November 4th, the Friday before the election, when Mr. Comey came out again and said, well, we did not find anything worthy of continuing to investigate. The investigation remains closed. Taken as this, of course, from the 28th election down to the 4th, is taken as a severe negative for a negative, whether it's severe or not. Turned out to be severe, yes, but at the time we didn't know it. A negative for the Clinton campaign. The reversal, or at least the avowal by Mr. Comey that there was nothing more work to do on the email server, was taken as a positive for the Clinton campaign, but also by the markets as a positive. The chart here with the hours, now you'll also see that we're in an uptrend in the DXY ever since the middle of the summer. Actually, the early part of the summer, the late spring, actually. But those arrows are telling you that the markets were viewing the potential election of Mrs. Clinton both as expected and positive. Because the election is right here. You'll see it on some other charts. This was a late chart, so I didn't have time to draw two arrows. What is interesting is after this brief pause right here, the market has continued. It completely flipped from here to here. Or you could even, from here to here. Or you could even say from here. In the US, people start paying attention to elections when they come back to what's happening, when they come back from summer vacation, September. So from September to here, almost 2 months, with Clinton leading almost all of the way, both in the prospective electoral college count and in the popular vote count. The market viewed that as a positive for the dollar, as a positive for the equities, for all sorts of things, which we'll take a look at. When there was that week-long hit, 9 days actually, from the FBI. The market took it as a negative for the dollar, and then back to here when Clinton looked like she was going to win. But after a brief pause, the market has resumed. So what we have is a market completely switching gears in the middle of an election. I mean, not quite in the middle, but if you look at the equities, here, why don't we do that? Let me bring up the equities chart. Let me find the Dow. Let me find the best one. That's not the best one. Dow Fed Funds. Here it is. DOE election. Okay. This is the Dow. Okay. So if we look from September to October, there wasn't a lot of directional movement in the Dow. Pretty much stayed the same. While the U.S. was paying attention, the Dow was paying attention to the election, the Dow was ignoring it by and large. Certainly not true of the DXY, as you saw. Or we could take the alternative view that up until this time, the entire period of September and October leading into the election, that the markets viewed the background, the assumption was a Clinton election. And so with that background, the DXY was rising because of it, probably because of anticipated increase in rates and probably slightly better economic statistics. And the Dow was stagnating for pretty much the same reason, at least as far as the interest rate side goes. So you don't see a lot of election interest here. The Clinton election is the assumption. And so the market, and a very strong assumption because of the polls, all of which were diluted, but that's another point. And you can look at it two different ways. Anyway, I'm not going to do election analysis. That's not what we're here for. Where you get the specific election event is here at the end. The absolute stunning announcement by Mr. Comey that they're reopening the election on the 28th, negative for the Dow, negative for the dollar, negative for interest rates. Okay, that's a view. We take it. The Dow did not like the fact from here to here, and the people trading the Dow, that the Clinton election looked a lot less certain because of the FBI announcement. Okay, so on the 4th, the FBI announces that it found nothing, and the investigation closed. Okay, so what does the Dow do? It actually reverses. Went from nope, negative on the election, positive, negative on the investigation, positive on the close of the election. Okay, so what this is telling you is obvious. The market is happy with Clinton being elected. Okay, we can see this right here. Yes, I know. Yeah, I know. I mean, you know, I try to say to people, it's an election. We have them every 4 years. There'll be another election. A lot of people on the other side were quite unhappy when Barack Obama was elected. Okay, you'll get over it. Go back to your job. I know I try to say that, but I think it has to do with the absolute unexpectedness of this particular election, more than anything else. Everything seemed to be looking one way and suddenly it was reversed. Okay. So back to the equities. So what we're seeing here is the part about markets that I really like. One of the things about markets I really like. This is the resurgence, supposedly, of the Clinton campaign because the FBI closed their investigation on the 4th, the Friday before the election. Okay. So Clinton loses. Why did the equities not plunge? And that's what we're going to talk about here in particular. Now, If you remember on Wednesday morning, the equities actually did that. I sat here overnight as the returns came in, and as it became clearer and clearer that Donald Trump was going to win, the Dow E-minis plunged. At one point, they were down 800 points. Everyone should have bought heavily down there. I'm sure nobody did. By the time the market opened in the morning, the Dow E-minis were down to, I think, about 200 negative. The market opened down about 177, if I remember. But it barely lasted. It's subtle. I mean, it's as if there was some sort of revelation. All of a sudden, everybody turns around, buys like crazy. We have been up to record highs since then and are again today. When I printed this chart at 9:35, as you can see this morning, the Dow was already up 65 points. What happened? What happened? It's as if the ideas that the Republicans and Donald Trump had been talking about were suddenly looked at for the first time. So the market judgment, as, shall we take this as a sign of supreme inconstancy? We can. But what the markets are now doing, and that's not just in the equities, it's everywhere. Okay. I have some historical stuff here, which we may get to, we may not get to. Let's take a look. We had this one up before. DXY, same exact thing. Hillary Clinton, less likely, negative for the DXY. Hillary Clinton, more likely, positive for the DXY. Donald Trump elected, not Hillary Clinton, positive for the DXY. But that's what happened. So we have to do what we have to do. And this is what everybody in the market apparently did instantaneously. And you know, as the markets turn, everyone in the various markets pays attention. So if the Dow, I didn't check which market on, say, on the minute chart actually turned first, whether it was the Dow or the DXY or the commodity markets or the credit markets. I didn't check that. But it doesn't matter a great deal because the markets are all reinforcing. One of the markets turned first. My guess is it's the Dow. It's the equities. And suddenly everybody followed. It suddenly became obvious, although it was always obvious before, as to what the initial likely policies are to be. We're talking economic here, from an incoming Trump administration on January 20th. And what are they likely to be? And why are we here? And the next question we'll, of course, ask, but it's really a philosophical question, is why didn't the markets get it to begin with? Now, you could say here, or in the equities, that the reason the dollar went down is because Donald Trump was going to lose. The problem is this turn right here, or if you like it in the election on the equities, the problem is this turn right here, right? That little V and recovery is not telling you. Yes, one more comment on this for the comment up there, and I thank you for that. I think that's, is it Maurice? Is that you with the comment? Anyway, as I said earlier, it's an election, folks. We have them periodically. We've been having them in my country, the United States, for, I don't know, 240 years, 230 years. There'll be another one in 2 years and 2 years after that. This is what we do. It's not the end of the world for anybody. And we'll have another election. And as long as we keep having elections and not revolutions, we're doing fine. That's my only close to political comment on the topic. Okay, so the problem with viewing the decline as a comment on the likely, this period right here, the likely defeat of Donald Trump, is that as soon as the incubus, that's a very fancy word, for the Clinton campaign in the form of the FBI reopening of the investigation was removed, the Dow skyrocketed. This is telling you, and there's just no way around this, that the market viewed a Clinton election as a good thing. Now, you could look at the reasons why. I mean, the reason didn't make a lot of sense. Some of them did, some of them didn't. One, continuity. No change, no surprises. You know you're going to get that with the Clinton election. It's basically the third term of the Obama administration. Okay, you know what you're getting. Markets don't like surprise, they don't like uncertainty. But what happened here? Once that was removed, and the markets, as much as anyone else, were snowed by the reporting and the polling on this election. The markets were not really passing judgment on Ms. Clinton's potential economic program. They were simply passing judgment, it appears, on continuity, on lack of uncertainty, on we know what we're getting here, on continued zero rates, on all of the things that have gone in the past 8 years to make up the economic world and the economic predictive world, which of course is what the markets are all about. Once, and it appears to me that no one paid any real attention as to analysis as to which potential program would be better for the economy. Now, I am not, again, talking culture. That is not my purview. That is not my area. That's not what I talk about here. As I said earlier, I have my opinions, of course, but they don't belong here. What I am talking about, though, is the potential, and this was known beforehand. There's a lot of surprises coming out, but the market's acting as this is a huge surprise. What happened here is, for better or for worse, everybody didn't just sit down and say, hey, we better examine this program here, but everybody kind of knew what it was. People who are trading, people in the markets, they read the news, they understand what a Trump administration in general might be like, as far as its policies go. So did this all happen in 5 minutes? No, it was always lurking in the background. But this is a judgment, and there is simply no other way to approach this. It's a judgment on the potential Trump administration economic policies in the first year or two. That's all this is. Okay, let's take a look at another one. This is the, here, let's look at the most, where's my other 10-year? Okay, it's 10-year. Here we go, same thing. This is, of course, the 10-year yield. The 10-year is probably the most consequential commercial yield. It tends to set things like mortgages, or at least be referenced seriously for mortgages and all sorts of long-term economically important interest rates. The commercial rate sector of the markets of the economy. And the interesting thing you're seeing here is a complete reversal of what was expected. Again, we have the same issue here. This is the Comey dip, as it will undoubtedly come to be called in the future as this election and its economic effects are written up. Now, why did this happen? Well, this is a different reason, but the same idea: continuity, uncertainty. As the election potential, likelihood of Clinton went down in this period, the market saw uncertainty. They saw lack of continuity. They said, we have no clue what we're getting with Donald Trump. As this is the 9th, the 8th is here, right? This little one right here. I know it's not a great picture. You just can't get it too much bigger without losing the sense of the trend. And I'll show you others. I mean, since the middle of the summer, 2-year and 10-year rates have been rising. As the Fed makes its noises about moving into the end of the year, the economy tends to look a little better. It's impossible to believe that this is not a partial market judgment as well, but we'll leave that as it is. On the election, I meant. So as from the 28th to the 4th, Clinton's election prospects dip a little bit, so do the rates. Why? Well, you know, Donald Trump is going to be a huge disruptor. We're going to have uncertainty. Everybody's going to rush for treasuries, driving rates down, as always happens when things look a little more dicey than they did before. So again, the question is, what happened? We have almost remember the top on the 10-year was over here and it was 3%. Look at this, we've gone from 180 to 224, okay? That's 44 basis points in about 4 sessions. This is a big move. It qualifies on the price side, and I'm sure you've seen this as carnage, the inevitable carnage in the bond markets because everybody's selling bonds. From fear of uncertainty to hope for economic growth in the basis of about an hour and a half on Wednesday morning. You must like the lack of continuity in market judgments. If this were the type of reversal that takes place for political or cultural items, you would hear the word hypocrisy written in the largest letters possible. But of course, it's not. I think what we're seeing, well, definitely what we're seeing is one of the fascinating psychological aspects of markets. But besides that, it is the ability of people in markets to simply not look at something that doesn't have to be looked at. As long as it appeared that Clinton was going to get elected, nobody had to actually look at the likely effects of a Trump administration. Well, they had to, and they did. Suddenly, what did they find? You know what? This might work. As far as the economy and the economics goes, what are we talking about? What are the likely things that Donald Trump's administration will do? Well, they're fairly easy because he said them over and over again. It's just nobody's listening. Government stimulus. He's spoken about, I don't know, trillions of dollars of government stimulus. What does that do? Well, pumps money out into the economy, gives people jobs, creates debt, whatever. It usually sponsors growth. Business deregulation. How is that going to be a problem for business? The curtailment or the change of Obamacare. Not making any judgments, again, on the purpose or the success. It has imposed quite a number of costs on business, and it has also imposed a number of premium increases or prospective premium increases on various people using the insurance programs. Well, money spent on insurance doesn't get spent on other things. Insurance premiums aren't going to generate nearly the amount of jobs that consumption will. So if the program succeeds, whatever the Republicans are going to do, and I have no idea, at least I'm not going to talk about it, that also would likely put more money in the hands of consumers, which they will, to some degree, spend. Probably a further effect of a Trump administration, and he has spoken about this, are taxes, corporate and individual. And they will not be raising taxes, they'll be lowering. Will this add to the deficit? Of course it will. And that's not the issue here. But from a economic growth point of view, what is the likely result? I think we all know the answer. I'm not saying I'm having to make my qualifications here more often than I normally do in a webinar, given to the volatile nature of the topic, shall we say. I will say to my European friends, despair not. Nothing much has changed. You'd be surprised. Okay, so of the tenets that we're seeing for potential the Trump administration, or the using government stimulus spending, business deregulation, tax reduction, the hopeful curtailment of interest rate rises, and a sense also, whether you like the direction it's going or not, of legislative movement in Washington. What will happen, of course, is the Republicans now control all three branches of government. They have the presidency, they control the House of Representatives, and they control the U.S. Senate. That's an enormously powerful position. It's a position, actually, the Democrats had 8 years ago with the first election in 2008 of Barack Obama. So politics turns. So it is expected, of course, that they will get through a number of things that they want to do. So for these reasons, the market suddenly decided on Wednesday morning that, hey, things don't look so bad as far as the economy goes. Has anything changed? No. But the potential, if you're going to bet, that's the bet. So they are telling you. Now, there's, of course, the other aspect. I don't know that Mr. Trump or his people have spoken about zero interest rates. I'm sure they have. I believe that their opinion is that they are a negative for the economy, but I'm not sure about that. But he has said that he originally said he'd replace Janet Yellen as chair of the Fed. Well, since she's the primary champion, at least the most vocal one, of take it slow, if at all, one could assume that you would get a different cast. He has since said, though, Mr. Trump, that she will serve out her term into 2018. She will probably not get replaced after that. From a business point of view, Mr. Trump, from a personal point of view, Mr. Trump's a real estate man primarily. Cheap borrowing is good for your business. It's easy to borrow money to buy properties, since almost all properties are purchased on credit. But it's also true, and I've said this for a number of years, that permanent low interest rates like this distort the economy in ways which are hard to track, but perfectly understandable. And one of them is that it's very difficult to plan for multi-year growth when you expect at some point your interest costs to double or triple without knowing when, and without knowing whether it's going to double or triple or quadruple. If you start at 0.5%, a quadrupling of costs, we're talking the Fed funds rate, of course, is not only normal, it wouldn't even be back to the normal level, historical level of it. So, just here, we're going from 1.4 down here back in July, 100 basis points higher. Well, not quite, a little bit less than 100 basis points, 86 basis points higher. That's a big change for the bottom line for anybody who's using credit. And it doesn't even get us remotely to where the 4.5 historical level of even 3 of the Fed fund of the 10-year is. So let's look at a few other charts here just to get an idea. Okay, now let's talk about, we talked about US equities. Let's talk about overseas equities. This is the MSI Global Equities result. And you can see exactly the same movement here. I didn't put it down as far as the arrows go, but this date here is the 28th. This is the 4th, the red arrow. It goes back up just like the US equities and then plunges again. So what's the difference in this chart? This final leg is the reverse of the US leg. Now, you could say this makes no sense. If US equities think that a Trump administration is going to be good for the economy, and that's what they're telling you, that's what that chart means. Remember, these are not cultural values. They are economic judgments. The Dow chart is telling you that the markets have decided very quickly, and without the least bit of embarrassment, which I kind of like. We were wrong. We changed our mind. Other way. Cool. What this is telling you is very different. My guess is that if Clinton had won, this down leg would be up, just like the U.S. equities. And the amazing thing is, if the election had turned out differently, if the Clinton side had won, you would see a similar, although probably not quite as pronounced, there weren't quite as many shorts perhaps to cover, chart in the equity. U.S. equities chart wouldn't have looked a whole lot different, which makes zero sense, of course, but there you go. This, of course, is telling you it is speaking of a different concern, and it's speaking of a political concern. And it's also speaking of the DXY chart. It's speaking of a higher dollar. So there are a couple of things working here. The least important, I think, is the Trump administration's potential for, how shall we call this, trade confrontation. That's in this. No one knows how it's going to play out. I think the expectation is that the rhetoric will not produce the same type of fiery results that you saw rhetorically on the campaign trail in actual political and economic policies followed by the administration after July 20th, after June 20th. But what else are you seeing here? Well, you're seeing the strength of the dollar, of course. Emerging markets tend to be resource-driven economies, not entirely, of course, by any means, and as the dollar strengthens, of course, commodities are priced in US dollars, prices go down. Okay, let's take a look at, so that's probably the largest story here. There's a huge issue if US interest rates, this is another reason for equity markets and the emerging markets to fall. If U.S. interest rates are really going to start rising, I mean, I heard a report this morning that, we're heading back towards inflation. I don't know that I buy that one, but certainly the deflationary impetus coming out of China and other places is probably diminishing. So if U.S. interest rates rise, then the enormous amount of money borrowed, it's going to be difficult for many countries that are heavily indebted to refinance debts. Remember, sovereign debt, like corporate debt and some personal debt as well, they're rolled over. They're not paid off. They're simply refinanced. Well, you're going to be refinancing at much higher rates if U.S. rates go up. And that will be an enormous cost and a drag on many economies. That's another reason behind that. So there are good reasons, the smallest of them, I think, political, as to why emerging markets currencies equities have fallen. And here we go. We see a similar thing in emerging markets. I don't know what share the peso is of this, but the logic is the same. Emerging markets currencies and countries are going to have higher interest costs. Their exports are going to be less valuable if they're resource-based because they're all based in dollars. The prices they're going to get are going to be lower. So the economies and the currencies, but primarily the currencies, reflect that. This is the 28th. There was almost no bounce. This is the 4th right here. So there was a tiny little bounce down because what you're looking at in the currencies and also on the emerging markets equities, there's far less, they're far less attuned to the vagaries of US politics. They're more attuned to the interest rates in the United States and the dollar. And that's what you're seeing reflected on here. So for the emerging markets currencies, huge hit here. Let's look at the one which has had the greatest hit, of course, and it's the Mexican peso. And this is both political and economic. The interesting thing is with this is probably the most political chart we see and we've looked at today. The Mexican economy, of course, is largely tied in its success to the success of El Norte. It's a great movie about that about 30 years ago. I went to see it with my sister, about Mexican immigrants to the United States. Great movie. This is largely political. And I think somewhere around here is probably a good point to short them, to go long the Mexican peso. Because the Mexican economy actually rises and falls with the success of the US economy, for obvious reasons, without passing any judgment on that whatsoever. So if the equities are saying that the US economy is probably going to prosper under the initial policies of the Trump administration, then why shouldn't the Mexican as well? Well, because we have the issue with borders, which were such a volatile and excitable topic for the Trump campaign, and everyone is assuming that it's one of the thick promises that he will keep. Therefore, there are some problems potential for the Mexican economy just based on that, and that's what you're seeing here. So as I said, this is probably the most political chart of all the charts we have here. So let's look now at and I'll get some closer charts here. This is the commodity index. Remember, we're looking at from June, it's pretty much been going down. Let's look at the DXY. And what do we have in the DXY? Well, no surprise here, right? So the commodity index is going down from June. What's the dollar index doing from June? Of course, it's rising. The two are hardly coincidentally related. One of the reasons the commodity index is going down is because of that relationship. This, of course, relates to the commodities index, to the emerging markets indexes, both equities and currencies that we looked at. Stronger dollar, lower prices, higher interest rates in the United States, higher interest costs, higher refinancing costs. All of these things are reflected in the equity and currency indexes for the emerging markets. So this trend that we are participating in with the election, that's all it's doing. Commodity prices have been in a down channel, and a fairly gentle but still pronounced down channel for 1, 2, 3, 4, 5, 6 months. And the movement based on the election right here is right smack in the middle of the channel. So there's no reassessment, interestingly enough, of the overall trend based on last Tuesday's election. There is a reversal in the equity trend, the US equity trend. But there's no reversal in this trend right here, which is the worldwide commodity prices, okay? Let's take another look here. Okay, we did that one already, sorry. Okay, this is the same idea, and I wanted to cover it before we stop. This is the 2-year in the US, the one that more closely relates to what the Fed is doing. And what are we seeing? What happened in 2013? The taper tantrum, which reflected Mr. Bernanke's first public notice that QE might end. Ever since then, as a very rough trend, of course, this in the middle of 2014, actually, no, it's over here. Forget that one. Sorry. Can't be perfect. So the uptrend for short-term rates has been higher for more than 3 years, a very steady trend. It's gone from 0.2, which it was only anywhere remotely near there because of QE, up to 1%. So again, in commodities, 6-month trend. In short-term rates in the US, there's a 3-year trend. The vagaries of the election and the response of the markets haven't changed this a whit. They're operating within trend. So the trend higher in currencies, in yields, treasury yields, and the trend lower in treasury prices has nothing to do with the election of Donald Trump as president, simply reaffirming a trend that's been going on for 3 years in the 2-year. Here's the 10-year. Now, this is where we see, so the 2-year has been assumed higher for 3 years now. This is where it gets interesting. Everybody knew that the Fed funds rate would not stay at 0.25. That's been the operating assumption of the markets for 3 years. The short-term end is going to go higher. But look at the 10-year. This, like the equities, is a potential reversal of trend. Although this trend goes back more than a year, it goes back almost 2 years, and the equity trend is much shorter. But this is telling you that something probably has changed. And it's interesting to think how the markets perceive this. The Fed under Janet Yellen has made it patently clear that it wants to raise rates. That's been going on since Mr. Bernanke first spoke of ending QE for 3 years. But what the market hadn't been assuming, at least not the same way. Now you can make the argument that this movement right here is some sort of break in the trend, but I don't really agree with that because you don't know that. The trend is down. It's a wide channel. And until you actually get the break, as we did, you don't know whether the trend is reversed or it's simply contained in the downtrend. So what this chart is telling you is that something has changed with this election. That the medium term, the short term rise in interest rates was always assumed for 3 years. But this is a different order of things. Because this is telling you that the extraordinary interest rates of the past 8 years are probably not going to stay. There are 2 appointments waiting on the Fed board right now. They'll be watched very closely. But the market assumption seems to be that we are headed back to more normal range interest rates. And this is an election difference. Even though this is the case, you have this extraordinary rise in equities. What else is that telling you? That the judgment, now this can all reverse, but the initial judgment the market is telling you with this chart and the equity chart, the Dow chart, and the other equities look the same. The Dow is the best known, that's why I use it. I think it's the best known overseas, that's also why I use it. These two charts together give you a very interesting point. That is that long term, and we've already reached that point, low interest rates are detrimental to the economy because you could not have records in the Dow when the downtrend in 10-year rates has clearly been broken to the upside, were that not the judgment. So as has been happening for several years now with the relationship between the credit markets and the Fed, it is the credit markets that are leading the Fed rather than the other way around. This did not take place because Janet Yellen said interest rates at this level are detrimental to the economy, we're going to change our policy. That's not what happened. It was catalyzed by an election, but the judgment is that going forward, things will change. And that's why you have this tremendous rise in the equities, along with this tremendous breaking out of the down channel in 10-year rates. Okay, folks, I thank you very much for attending. I do apologize for the slightly late start today. We will resume this next week. I will have not decided on the topic, but after, most likely when I write it up on Thursday, it will be some variation of this same topic, since this is not just the topic du jour, but it's likely to be the topic of the next several months, as the effects of this election and the perceptions of this election work their way out through the markets and through the world. I thank you all very much for attending. I hope this has been helpful, and we will see you next week. Everyone take care.